Hello everyone and welcome to Fun with Fitzy. This is chapter 10 in which we're going to be talking about fixed assets, also known as capital assets. Capital assets are long-lived assets that are used in the operations of a business and are not intended for sale to the customers. So just to differentiate here, when you buy merchandise as an asset, that is intended to be resold. When you buy assets that you're going to be using yourself in the business, these are classified as capital assets, otherwise known as fixed assets. Now, there are two different classes of fixed assets. One is tangible, and the other is intangible. Tangible is like you can touch and feel it, like a desk is a tangible fixed asset, whereas an intangible is something you cannot feel or see necessarily. So let's just go into the differences between those. So tangible capital assets include things such as property, land, plant is like your building or your warehouse or your factory, and equipment you use in your business. Natural resources are also capital assets for many companies, such as mineral deposits, oil and gas reserves, and forests full of timber. You could think of a mining company that owns a mine, and that would be a big capital asset for the mining company. Samples of intangible capital assets, you've probably heard of some of these. These assets provide future benefits through the special rights and privileges they bring to the company. A patent, for example, is something you've probably heard of. When a company manufactures something, they are able to apply for a patent which gives them protection from other companies replicating the exact same product and selling it. And the reason why we get patents is because it costs a lot of money to do research and development into products. So the government wants to protect those companies that are willing to do the research and development and award them patents for several years so other companies can't. Many drug manufacturing companies get patents all the time. Copyrights are other examples. You've heard of copyrights. It's like to protect creativity. Writing, for example, is copywritten. You can't just copy and paste textbooks, for example. Sports contracts and trademarks. You see trademarks all the time, like lots of company logos have a trademark. That means other companies can't copy them. So with capital assets, when you buy them, you have to follow something called the cost principle. This is another GAAP or IFRS principle, similar to what we talked about before in the course. And when the cost principle is basically you need to record the asset at the cost in which you paid for it. This is pretty straightforward in most cases. If you buy a computer and you pay $1,000, you record $1,000. But some of these assets or capital assets, they have other costs associated with purchasing them and should be included in the price. So if you purchase one of these things, these are all the costs that should be included. The cost to acquire the asset, okay, so $10,000 piece of machinery, and number two, to make it ready for its intended use. So if there's anything you have to do, maybe you've purchased a piece of equipment for $10,000 and it's going to cost you $1,000 for the company that you bought it from to set it up in your factory to get it working. Well, that is making it ready for its intended use, and so that would be included. Some of these included costs should be obviously the purchase price, what you paid for the asset, costs to get it to you, and like I just talked about, costs to get it installed. When you purchase land, the cost of the land should include the purchase price. Now, closing costs such as title and legal fees, these are all things that you need to get a lawyer when you purchase a house or something like that. You will have closing expenses, so those will all be included in them. And then, of course, accrued property taxes and other liens on the land assumed by the purchaser. So property taxes are things that, unfortunately, we have to pay in Canada. Yes, there's lots of taxes in Canada. We've already talked about HST. We've already talked about taxes, income taxes. And now we're going to be talking about property taxes. So when you own property, yes, you are required to pay tax to the government every single year. It's called property tax. So any property taxes that have accrued thus far should be included in the cost of the land as well. Plus all necessary costs incurred in making the land ready for its intended use. We will debit them all to the title of the asset account, which is land in this particular case. Same for buildings. The cost that you must record when you purchase a building includes all necessary expenditures relating to the purchase or construction of the building. So when a building is purchased, such costs include the purchase price and the closing costs. So there's your lawyer fees again. Costs to make the building ready for its intended use consist of expenditures. You might want to remodel the building, replacing, repairing the roof, floors, wiring, plumbing, things like that. Those should all be included in the cost of the building. And when a new building is constructed, costs consist of the contract price plus payments for architecture fees, building permits, interest payments during construction, and excavation costs, etc. So basically, like we said earlier on, the cost should include the cost of the asset and anything that is related to getting the asset ready for use. Similarly with equipment here, it's the purchase price plus the freight of getting it to you and any insurance you would pay in transit in case there's an accident or it gets stolen or something like that. It includes any installation or assembly or testing on the equipment. And that's it for this video. By now, you should be able to describe the difference between tangible and non-tangible capital assets, what is the cost principle, and then determine what cost should be included in the purchase price of all types of capital assets. Thanks for watching, and Fitzy out.